all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to The Long-Term Investor. I'm Peter Lazaroff, and today I'm thrilled to be joined by a true legend in the world of investing, Charley Ellis. If you've ever felt like investing is harder than it used to be, or that the odds are stacked against you when trying to beat the market, then this conversation is a must listen. Charley is probably best known for his wildly important best-selling book, Winning the Loser's Game, but we also talk about his newest book that just came out called Rethinking Investing. He spent decades advising institutions, studying market behavior, and uncovering why even the smartest investors struggle to outperform over time. If you're not familiar with Charley's work, he is just an absolute master at distilling complex financial truths into simple, actionable advice. And so whether you're a do-it-yourself investor or you work with an advisor, this episode is really, really great. Now, before we jump in, I do want to invite you to subscribe to my free newsletter. Every 2 weeks, I share insights on investing, personal finance, and decision-making delivered straight to your inbox. It's the best way to stay up to date on the strategies and frameworks I use to build long-term wealth. And so if you just open up the episode description in your podcast app, you will see a link right there to subscribe. Or, as always, you can go visit thelongterminvestor.com. All right, let's get into it. Here is my conversation with Charley Ellis. Charley Ellis, welcome to The Long-Term Investor.
Thanks, Peter.
This is just a thrill for me, a career thrill. So much of your work has shaped my thinking on investing. Anytime you write anything, I feel like I absolutely have to read it. When I see that you're speaking, I have to see it. When I first read Winning the Loser's Game, that really kind of opened my eyes in understanding what it is I'm up against as an investor. And so I was hoping today, before we get to your new book, just to have you talk a little bit about that. Do you mind defining what the loser's game is?
Sure. It comes from a wonderfully intelligent man named Simon Ramo, who was TRW's leader when it was the dominant factor in our space program. And he also played violin in a quartet of professional musicians plus him at the Los Angeles Symphony Orchestra. And he was a gifted amateur tennis player. And he figured out that in tennis, most people don't actually win the competition. Somebody else loses the competition. And that if you watch most matches in tennis that are amateurs, and he pointed out there are two different games, one's by professionals and one by amateurs, and the same rules, same equipment, same court, same way of counting, but the games are completely different. Experts win points just barely beyond the reach of the other player. Amateurs lose points. And if you want to win the match, what you have to do is just keep the ball in play and let the other person make the mistakes that inevitably will happen. And pretty soon you will find that you were, quote unquote, the winner. But you did not control the outcome of the game. The outcome was controlled by the loser.
So interesting to hear the background. Now, tell me, Charley, why is money management a loser's game?
Well, it used to be a winner's game years ago when most of the investors, 90% of trading on the New York Exchange, was done by individuals who had absolutely no access to research, had not studied or trained how to be analysts, did not understand investment theories. Just they would occasionally buy or sell for whatever reasons they had. That environment made it pretty easy, if you had anything like good information, to do much better than the market. And when I first got involved in the investment field in the 1960s, that's a long time ago, but in the 1960s, if you wanted to make a meeting with a senior corporate executive, you call them on the phone and say, I've done my homework, I've studied your reports for the last several years, and I've got several questions I'd like to ask you, and it would take at least half an hour, maybe an hour. May I come and meet with you? Oh, I'll be delighted to have you come, because the corporate executive knew that they were trying to be sure they were getting a fair price for their stock. And the more people they had investing in their stock, the more they're likely to get a fair price and also a little bit higher price than otherwise. So that could be a corporate asset if you were acquiring other companies or defending against being taken over by other companies. So corporate executives thought they were doing the right thing to give information to investors, particularly professional investors. So you could get good information and then take that and go into competition with people who had no information. And in the proverbial, it was like stealing candy from children. Well, that changed a lot, massively changed, so much so that you wouldn't even recognize. And the world of investing today is candidly completely different. And I can give you a whole bunch of different illustrations if it would be helpful.
Yeah, let's do that.
Well, first of all, it used to be that 90% of trading was done by individuals. Now more than 90% is done by professionals. And those professionals are formidable. They typically get very well paid to be very, very good. And if they're not very, very good, they get displaced. Their clients will say, no, I'm going to shift to somebody else. So the quality of competitors is really up there. And the second thing is technology has changed massively. When I first got involved in the investment field, slide rules were the technology. Pretty exciting to have a slide rule. Yeah, that's fine. But how about computing power? Now everybody has more computing power than anybody had 60 years ago. You carry it around in your pocket. It's called a cell phone. And you can do more calculations with that device than other people were able to do years ago. So big change. Another big change is the law. It used to be that there was no law against corporate executives giving information to individuals. Now, SEC has made it clear that any publicly listed company or publicly owned company that gives any useful information to anyone must make a concentrated effort to get that same information to everyone. So the obvious answer is you have a quarterly call. Everybody in the world can call in, listen to the same information, and then try to figure out what they could do that might give them a comparative advantage. But the leveling of the competition by giving everybody the same information at exactly the same time as a matter of law is really, really powerful. Then you think, okay, what else has changed? You're kidding. Mike Bloomberg's wonderful devices, the Bloomberg terminals, they are unbelievable in terms of what you can do to gather information, to process it virtually any way you want to. And there are hundreds of thousands of those terminals all over the world. So anybody with anything like ambition to be really competitive has got one at the office, might have one at home, and there are many people that have one in their car so that as they're being driven to work, they can operate the terminal. Well, okay, the internet would be another technology, instantaneous distribution of information all over the world. Another change that's really important to keep in mind is it used to be that if you were a Canadian investor, you invested in Canada. If you were a Mexican investor, you invested in Mexico. If you were a British investor, you invested in Great Britain. Now everybody invests all over the world. And the access to information from really superb research analysts has gone up and up and up and up, and is now just extraordinary resource available all the time to anybody who is in the field. So we have really changed the nature of the market. And it's become a better and better market in the sense that what markets are supposed to do is find a correct price. And the markets that we have today are so endowed with information and so endowed with talented operators and so competitive that the price discovery process, which is what markets are theoretically all about, are in play in a very, very effective way. So they're not that the prices are exactly right, but they are so close to right that chances that any one of us could improve on that best estimate being made by experts all over the world with money at stake is very unlikely. And to be able to do that on a regular basis by enough to cover the cost of trying, just not there.
I want to reemphasize a couple things I heard you say. So important for our listeners and our viewers to understand is that we're not saying that prices are perfect. We're saying that for somebody to identify mispricing and profit from it, those are two different skills, continuously year after year is very, very difficult. And the competition is so high that the relative difference in these investors is so small. So you talk about it in your new book, Rethinking Investing. You talk about it in your past books. These are all brilliant people. We're not saying active managers aren't brilliant, but they're all brilliant. I think if you're a sports fan, it's easy to see in something like baseball, or everybody's throwing 100 miles an hour and everybody's a good hitter. And when the competition, then the skill level gets so high and the dispersion gets so tight in terms of skill level, well, then luck starts playing a bigger role. And so you're a big advocate, and you have been for a long time, of not trying to play that game, not trying to win, but just not losing. And I think index funds is typically where you've pointed. Is that a fair assessment?
Well, yeah, and in all fairness, if you look at index funds versus active managers, if you choose to be an indexer or an ETF investor, you're virtually sure of being in the top quartile in terms of investment results over a reasonable time period. Probably be in the top half of the top quartile. And, that's dream come true. Oh, who wouldn't settle for, give me that? How about give me that on an assured basis with lots and lots of data to support that's the way it's going to continue to be.
Well, I am going to dig a little bit more into this idea. But before I do, you spent many years at the Yale Endowment, where David Swensen changed the way that institutions thought about investing. And so it's hard to think of an investor. And I tell people that if you're using index funds, I'm not going to fight you. Can you use other low-cost systematic approaches? Yes, but indexing is never really the wrong answer for anybody. You could maybe make the argument that somebody like David Swensen, who showed ways in an unusual manner to deviate from the broad market exposure and add return, maybe he's someone who shouldn't have, with the benefit of hindsight, needed indexes, but even he said that that's something you should do. Let me ask you this, though. All the time that you spent at Yale, what is it that you think that people misunderstand about the skill that's applied and things that institutions like that are doing when they choose not to index?
Wonderful question. And can't tell you how much I feel strongly about the answer. First of all, David Swensen was a really, really nice guy. And he had the ability to develop relationships with other people that were just special. I was devoted to David. I would do anything to help him at any time. And I think there must have been a couple thousand people in the investment world that felt exactly that same way. The second thing is he was very disciplined in every way. And that discipline focuses the mind on doing exactly what you have figured out is the right answer. The third thing is David was extraordinarily creative. Most people have never even begun to think about this, but he is the first person to execute a transaction in a derivative. Now, derivatives are larger than the cash market. But what was the derivative that he executed? It was an interest rate swap between the World Bank and IBM. One had fixed rate debt, one had floating rate debt. And David believed that the interests of the two organizations were such that he could do a swap from one to the other. Oh, no, David, you can't do that. Nobody's ever done that. I know nobody's ever done it, but I really think it's the right thing for these two organizations. And I think I could set it up. Oh, you're never going to make it. Can I try? Sure. Waste of time, but go ahead. $100 million transaction. And there's a rumor that says he got 1% on each side. But that was a brilliant, creative move. Nobody had ever done a derivative transaction of any kind in securities. And of course, today, that's the largest part of the total market. So you have to understand how lovely a nice guy David was, brilliant enough to do that transaction, brilliant enough to do a superb job as a PhD student at Yale, working with Jim Tobin. And Jim Tobin was a Nobel Prize winner. The two got along really well because they were both brilliant and creative and disciplined and hardworking.
It's a lovely example you give, because if memory serves me, just as an example, when people think about what institutions do, and the best institution is that, and what David was a pioneer in, is doing things that others weren't. And even in venture capital, they were very early in their venture capital exposures relative to their competitors, other big university endowments.
Being first can be a terrific advantage if you're first and right.
Huh.
And one of the great things that David brought to the process was the courage to be first and the knowledge and understanding that he had done such rigorous homework that he knew what he was doing. This was not speculating. This was not gambling. This was not taking a chance. It was very focused, disciplined execution of smart moves that he understood all the dimensions of.
And let me stay on this track just a little longer on Yale and institutional investing as a whole, because you've spent time at a lot of institutions. Let me tell you, Charley, I am in front of charitable endowments, university endowments, healthcare endowments, and they range anywhere from, say, like $5 million to $500 million. And a lot of times when I hear their investment committee, and they're a group of people who've been donors and, maybe they have experience in some portion of the finance world, a very small, specific place in the finance world. But they sort of feel like if they aren't using alternatives like Yale does, all in kind of air quotes, then they're not doing it right. I just don't feel like they understand how much talent and effort and thoughtfulness goes into a lot of these endowment operations. Do you think it's reasonable for any given endowment, let's say even just below 200 million, to be veering into some of these spaces that a place like Yale does?
No, I don't. In fact, I would urge anyone who is under 2 billion to say, I just don't have the resources to be able to design a competitive strategy that would allow me to be a serious competitor. And look at it two different ways. One, as a buying organization, will you be able to afford the quality of staff that would be required to have expertise in each of those different categories of quote unquote alternative investments? The odds are very slim that you would have full-time capacity to have first-rate talent competing on your behalf for the best relationships with the best managers. It just isn't going to happen. You think about that, okay, that's perfectly fair. It's not that a 5-year-old boy can't play professional football, but he can't play professional football at 5 years of age. He's going to have to wait till he's 25 or 30 in order to be big enough and himself enough. If you look at the dispersion of returns in each category of alternative investing, real estate, venture capital, private equity, so on, look at the dispersion of returns. The very top performance is wonderful. The near top performance is good. The not so near top performance, and you're still talking about much better than the crowd, is not the market average. And below that, it gets painful. The average investor loses by going into alternatives. There are some people who go into alternatives who have the skills to make it into something really remarkable. But the alternative managers who have those skills are very careful in their selection of which investors they're going to allow access to their skill set. And the answer is they're going to concentrate on large funds that are very expert and are quick to make decisions and have lots more money coming along for the next fund and the next fund and the next fund. And so you find, sure enough, ideal customers and ideal providers get together, and others should stay out of trying to compete because it's very hard to do.
Yes. And I feel like there's a lot of people selling access and selling expertise. But if you have 50 clients or even 15 clients that you're selling that expertise to, the best funds may not really want your money. That's not really the type of long-term capital they're looking for. And honestly, it's very tempting to keep going down this rabbit hole, but I want to hit some of the things that you're talking about in Rethinking Investing, as well as some of your past works. We were talking earlier about index investing, clearly a form of low-cost, rules-based investing. But I also referenced how there are other forms of low-cost, rules-based investing that people refer to as factor investing. I'll just be pretty plain. And so instead of just taking the size of the company as the only rule, it might assign weightings a little bit based on their price relative to some fundamental. What are your thoughts on this form of systematic rules-based investing like a factor investing?
Well, first of all, I really like the idea of being disciplined in your thinking. And secondly, I do respect those people who have studied segments of the market and found ways in which they can, in certain periods of time, get better results by using a particular discipline or factor. The problem is, for most of us, the problem is really serious. At the time that the results look most compelling, and the time when we're most likely to say, I'm going to do that, is after the good results have been achieved. And the future results are not going to be anything like a replication of the past. So I'm very skeptical of factor investing, except for those who are very skilled at understanding what the factors are and knowing what they're doing and when to go in and when to come out. And even then, it's going to be a relatively modest amount of incremental benefit. And for those of us who are not expert in the particular factor, I think that the net result over time will be we will pay a penalty for doing the factor investing. We'd be better off to do something as plain vanilla as index investing.
And is the key, it's just a matter of indexing is just an implementation strategy, and you just have to know what can you live with for 10 or 20 years.
And the time to be investing in a fund that is factor driven is when the results in the past have not been at all good. Then you might very well get a surge of the tide comes in, the tide goes out, the tide comes in, the tide goes out. But for most of us, we would be making a mistake if we went to factor investing, because most of us, being human beings, would tend to get excited when we could see there was a lot of evidence in support of the factor. But that's about when the tide has come all the way in and it's about to turn and start going out.
Well, Charlie, you make a great point, because I feel like I spend half of my time when I'm speaking with our clients just coaching them through anything that doesn't perfectly track the market. We have a lot of factor investors at PlanCorp. We have a lot of index investors at PlanCorp. But you're right, it's these behavioral things that make such a big difference. And actually, in your new book, you dedicate an entire chapter to behavioral economics. And in my opinion, you just can't take the human out of human nature. So my question to you is, how would you suggest investors protect themselves against these well-documented behavioral financial tendencies that tend to hurt our returns?
First thing is to pay attention to what the behavioral economists are teaching us and study the data that they're producing. You're right, a whole chapter on behavioral economics may sound like a lot, but actually it's the biggest single problem for most investors, and the penalty cost is huge. So one chapter seems like actually too little rather than too much. If you really want to get into it, Thinking Fast, Thinking Slow is probably one of the great books ever written about behavioral economics. And anybody that wants to be serious about investing should read that book at least once every year to remind them that as human beings, we are our biggest problem, and which is the way it's going to stay for a long, long time. So understanding the reality of behavioral economics, and that we're all in that place. We're all doing those sorts of things that we know we shouldn't do, at least when we're reading it in the book. Fine, but it is the biggest single problem. There is a solution, and it's really quite wonderful. We talk about indexing on ETFs as they are terrific because you have lower fees. Correct. They also are a fabulous protection against the perils and misbehaviors linked into behavioral economics, because indexing and ETFs are boring. They're not interesting. They're no fun. There's no excitement. So you kind of leave them alone. And it's a little bit like your mother taught you, don't pick at a scab. It won't heal as fast as if you just leave it alone. And if you do leave your scab alone, it does heal faster. And the same thing is true if you index or use ETFs. You are not all that excited by the market. You're not responding to individual stocks behavior because it's the same old. And you probably just benign neglect is actually a big positive. And let the market do what markets are doing when they're left alone, which is producing a terrific long-term rate of return. So I think anybody who's serious about investing needs to become proficient in understanding behavioral economics and what the problems are. And the easiest and most powerful data we've got is over a long period of time, the average investor penalizes himself or herself by 200 basis points or 2% on average, year in and year out. If you think, the market rate of return is going to be something like 7%. No, wait a minute, minus 2.5%, 3% for inflation. Hey, wait a minute, this is starting to get pretty squeezed. Taking another 2% out because of behavioral economics, wouldn't it be great if you didn't have to take that extra 2% out? If you could leave it in there, going for compounding over the long term, it'd be terrific. To me, that's the core value of this really short book. It's only 100 pages long, and it is a complete rethinking of investing, why you don't need to have bonds because you can have a spending rule that smooths out the fluctuations, and how you can therefore emphasize equities in a major way, because it really will work for you in the long run. It's just so much in the way of a real opportunity that we tend to miss, but it's all sitting there. And in a very short book, that's what Rethinking Investing is all about.
Well, I love that it's short. Actually, my most gifted book, I didn't tell you this before, is a book you co-authored with Bert Malkiel, The Elements of Investing. And I think sometimes the brevity and just focusing on those really key points are what is going to keep someone who's not really ready to read 400 pages on investing. It's what they need to see and hear and engage with. And I think your book did a great job really of just emphasizing that successful investing is simple, but it's not necessarily easy. There were a couple different things you felt like were required of an investor to have success. What are some of those things?
Well, the first is to understand who you really are as an investor and what are you trying to accomplish. And that leads you to realizing, hey, wait a minute, long term is not 6 months. That's what the tax man says. Long term is I started investing in my 20s. I'm still investing in my 80s, maybe my 90s if I'm lucky. Hey, wait a minute, that's 50, 60 years. That's long term for me. And if I am successful enough to leave something to my children, they're going to extend that 50 or 60 years out to 70, 80, 90 years. That's really important. And if you think about it, that gives you the freedom to do compounding, which Warren Buffett teaches all of us is the greatest force for good in the investment world. And if you compound and double every 10 years, which would be assuming a 7% return, if you double every 10 years, in 10 years, you go from 1 to 2, then from 2 to 4, then from 4 to 8, then from 8 to 16. Now we're starting to get your attention. From 16 to 32, from 32 to 64, from 64 to 128, all of a sudden you're like, hey, wait a minute. Those last doublings are really something. Call it the snowball, but they really are something. And the only way to get there is to get started and let time do its magical wonders on an overall basis. It's just unrelenting, the power of time. And if you think about it long term, you do have time. If you don't think about it long term, you will chop your investing into little bits and pieces, and you will never have the power of compounding working for you.
Since you mentioned Warren Buffett with compounding, the fun fact that maybe you know, but listeners may not realize is that the vast majority of Warren Buffett's wealth accumulated after he qualified for Social Security. Now that is compounding and doubling on the back end. You know, when you talk about these numbers doubling later and later, they just get bigger and bigger. And I think your book really focuses not just on the compounding, but the behaviors, on the competition. I mean, there's a lot of stuff getting in our way and trying to interrupt compound interest. And I think it ties back to what I was asking at the beginning, you know, what is the loser's game? If we're playing tennis and I'm trying to hit the ball as hard as I can and the ball ends up in the net or ends up going long, or heck, maybe I even get hurt trying to overexert myself. that's how you're going to lose this game as an amateur. And even I would say, Charlie, most people who are financial professionals should still be viewing themselves as amateurs. I feel like I'm very knowledgeable, but I would consider myself an amateur. I'm not going to be able to go out and beat people who are dedicating millions of dollars to the information they're collecting and the talent that they're hiring to analyze it. In my view, you either have to have better information than everybody else or be better at interpreting that information than everybody else. And that's a big thing to say that you are capable of doing. You'd be very confident.
You bet.
Let me ask you one more quick question before I let you go. We've established lightly in our conversation that traditional active management is largely ineffective. Some of it's because of costs. Some of it's because everybody's really good. And so the competition's so high. One of the things I find interesting in the past handful of years is there are a lot of investors who are believers in a rules-based approach, whether that's indexing or factor, but they're getting a lot of interest in private investments, whether that's private equity, private credit, private real estate. And the access to these products are rapidly expanding, but these are products in places of the investment universe that are inherently active. You have to have a thesis and it has to be an active bet and it's high cost. How do you feel about this growing trend and interest in these spaces by a larger swath of the wealth spectrum?
I personally shake my head and think it's a shame because individuals can't compete for the access to the very best managers. And only the very best managers are producing a return that is worth the effort. The average investor in alternatives of all kinds has an average experience that is not positive at all. And you don't get to that average without having some people getting absolutely suckered and having a terrible result. Locking up money and leaving it in one place for a long period of time is a real problem for most people. And it's nothing like the real problem of alternative investing, which is if you're not really a wonderful client, rich, substantial in assets with billions of dollars to play, you're not going to get access to the best managers. And as a result, you won't get the best results. And you got to be realistic. It's just that's the way life is. And it's a shame that we can't have absolutely marvelous life experiences and all of us be terribly good looking and all of us terribly smart and all of us have wonderful adventures one after another after another. But the reality is most of us aren't going to have those fabulous experiences, but we can still have very, very good experiences. And I think it's marvelous that something as simple as indexing and ETFs give a pathway to having a very good result over the long period of time if you just hang in there.
I love that you put a number on substantial wealth being in the billions, because there's substantial wealth below that where people, again, keeping it simple might just be the best approach, cause less headache, and lead to results that you'll be happy for. And Charlie, this has just been an incredible honor to have you. I'm going to be sure to put links to all of your books, but I'll put at the very top your newest, Rethinking Investing, in my show notes at thelongterminvestor.com. Truly a pleasure. Thank you so, so much for being a guest on the show.
Thank you, Peter. I enjoyed every minute of it.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.